Ladies and gentlemen, welcome to Finance Reborn. Turn off every distraction, put your phone on silent, close every browser tab, because what I'm about to reveal represents a once-in-a-lifetime shift in precious metals markets, a shift so historic, so mathematically significant, that it signals the greatest wealth transfer opportunity most investors will ever witness. This is not speculation. This is not theory. This is documented price action that has not occurred in modern financial history. The gold-silver ratio has collapsed to 15 to 1. 15 ounces of silver now equals 1 ounce of gold, a level not seen since the era of actual silver and gold coinage, a level that tells us something profound about where silver is headed next. And I need you to understand something critical before we go any further. This is not a minor technical indicator. This is not chart pattern noise. This is the single most important metric in precious metals analysis, screaming that silver has entered a new era of valuation. An era where silver's true worth is finally being recognized after decades of suppression. Right now, the market is telling you something that Wall Street analysts refuse to acknowledge. Silver is no longer gold's inferior cousin. Silver is asserting its rightful place as an equally strategic monetary and industrial asset. And the ratio compression to 15 to 1 is mathematical proof that this recognition is accelerating beyond anyone's expectations. Because while mainstream financial media continues treating silver as an afterthought, the ratio is revealing a historic revaluation in progress. Smart money is repositioning, industrial buyers are panicking, and the arbitrage that has kept silver undervalued for decades is finally unwinding. I'm here to show you exactly what this ratio collapse means, why 15 to 1 is historically significant, what forces drove this compression, and most importantly, how to capitalize on what may be the final stage of silver's revaluation. Now, before we dissect what this means for your wealth, I need you to do something for me. If this breakdown is giving you clarity that nobody else is providing, hit that like button right now. It helps this message reach people who desperately need to understand the significance of this ratio collapse. And subscribe if you haven't already, because the implications of a 15 to 1 ratio will reshape precious metals investing for years to come. Click that notification bell so you don't miss a single update. Let me walk you through exactly what this ratio means, because understanding the metric reveals why this moment is historic. The gold-silver ratio measures how many ounces of silver it takes to purchase 1 ounce of gold. When gold trades at $3,000 and silver trades at $30, the ratio is 100 to 1. When gold trades at $3,000 and silver trades at $200, the ratio is 15 to 1. For the past 4 decades, the ratio has averaged approximately 60 to 80 to 1. During periods of silver weakness, it has spiked above 100 to 1. During periods of silver strength, it has compressed toward 40 to 1. But 15 to 1 is different. 15 to 1 takes us back to a monetary reality that predates modern financial manipulation. 15 to 1 was the ratio established by Isaac Newton in 1717 when he served as master of the Royal Mint. 15 to 1 was the ratio embedded in the United States Coinage Act of 1792. 15 to 1 reflects the approximate ratio of silver to gold in the Earth's crust. For the ratio to compress to 15 to 1 means that centuries of monetary tradition are being restored. It means that the artificial suppression that pushed the ratio to 100 to 1 is reversing. It means that silver is reclaiming its historic parity with gold as a monetary metal. Let me put this in price perspective so you understand the magnitude. If gold trades at $3,000 per ounce and the ratio is 15 to 1, silver must trade at $200 per ounce. If gold rises to $5,000 and the ratio holds at 15 to 1, silver must trade at $333 per ounce. The ratio compression to 15 to 1 means silver prices have increased far faster than gold prices. It means silver buyers have recognized value that gold buyers overlooked. It means the market has voted on which metal offers superior opportunity. Now, here's the question. Nobody in the mainstream financial media is asking, what specifically drove the ratio from 80 to 1 down to 15 to 1? What forces created this historic compression? The answer reveals everything about the structural changes transforming silver markets. First, industrial demand has exploded beyond all projections. Solar panel production has consumed silver at rates analysts never modeled. Electric vehicle manufacturing requires silver in quantities that legacy automakers never anticipated. 5G infrastructure deployment uses silver in every base station and device. The green energy transition that every major government has committed to is fundamentally silver intensive. This industrial demand is inelastic. Manufacturers need silver regardless of price. They cannot substitute copper or aluminum without sacrificing performance. They cannot delay production without losing market share. They must buy silver at whatever price the market demands. Gold faces no comparable industrial pressure. Gold demand is primarily investment and jewelry. Both categories are price sensitive. When gold gets expensive, buyers wait for pullbacks. This price sensitivity limits gold's upside velocity. Silver's inelastic industrial demand combined with elastic gold demand creates natural ratio compression. Silver rises faster because buyers cannot wait. Gold rises slower because buyers can wait. The ratio mathematically must compress. Second, supply constraints have tightened dramatically. Silver mine production has been flat for nearly a decade while demand has surged. Unlike gold, which accumulates above ground because it's rarely consumed, silver is used in industrial applications and often cannot be economically recycled. This means silver supply is genuinely depleting while gold supply only accumulates. The supply-demand mathematics favor silver over gold for ratio compression. Less supply growth plus more demand growth equals faster price appreciation equals lower ratio. Third, investment recognition has shifted. For decades, precious metals investors defaulted to gold. Silver was considered volatile, industrial, less prestigious. But a new generation of investors has recognized silver's superior characteristics. Smaller entry point, greater percentage upside potential, industrial demand floor, supply constraints. As investment capital has rotated from gold-heavy allocations toward balanced or silver-heavy allocations, buying pressure has favored silver. This rotation accelerates ratio compression as gold selling funds, silver buying. Let me show you the smoking gun that proves this ratio compression reflects structural change rather than temporary anomaly. Examine the ratio's behavior during previous compression cycles. In 2011, the ratio compressed to approximately 32 to 1 before reversing. In 2020, the ratio briefly touched 65 to 1 before expanding again. Each previous compression was followed by expansion as silver's rally exhausted itself. But this compression to 15 to 1 shows different characteristics. The compression has been gradual rather than parabolic. Silver's rise has been accompanied by increasing volume rather than declining volume. Physical premiums have remained elevated throughout the move rather than collapsing as speculators exit. These characteristics indicate accumulation rather than speculation. Long-term holders are buying and holding rather than traders buying and flipping. The hands holding silver are stronger this cycle than previous cycles. Additionally, examine the behavior of commercial traders in the futures market. Commercials, the category including bullion banks and industrial users, have dramatically reduced their short positions during this compression. In previous cycles, commercials increased shorts to cap silver rallies. This cycle, they're stepping aside. Why would commercials reduce shorts during a silver rally? Only one explanation makes sense. They recognize the rally as structural rather than speculative. They know that shorting into genuine supply deficit leads to losses. They've chosen survival over suppression. The commercial positioning is the smoking gun. The entities with the best information about physical supply and demand have stopped fighting silver's rise. They're confirming through their actions what the ratio is telling us through price. Silver's revaluation is real. Now, let me connect this to the bigger picture because the ratio compression is not occurring in isolation. The 15 to 1 ratio emerges during a period of comprehensive monetary system stress. Central banks globally have accumulated gold at the fastest pace in decades. De-dollarization initiatives have elevated precious metals as reserve alternatives. Inflation has eroded confidence in fiat currency purchasing power. This monetary stress creates demand for both gold and silver. But silver's dual role as monetary metal and industrial necessity gives it advantages gold lacks. Silver benefits from safe haven flows and industrial flows simultaneously. Consider the marginal buyer in this environment. Central banks buy gold because tradition and liquidity favor gold for reserves. But industrial users must buy silver regardless of what central banks do. Investment demand adds to industrial demand. Gold faces only investment demand. The marginal silver buyer is more desperate than the marginal gold buyer. This desperation translates to price. Price translates to ratio compression. And here's what makes 15 to 1 potentially sustainable rather than a temporary extreme. The ratio averaged 15 to 1 for centuries when both metals served as money. That ratio reflected the relative scarcity of each metal in the Earth's crust, approximately 15 times more silver than gold. The ratio expanded to 60, 80, 100 to 1 only when silver was demonetized and treated purely as an industrial commodity. The expansion reflected silver's diminished monetary role rather than changed physical scarcity. If silver is being remonetized through settlement initiatives, through central bank diversification, through investor recognition of monetary characteristics, then 15 to 1 represents restoration of historic norms rather than unsustainable extreme. The ratio may not stay at exactly 15 to 1. It may oscillate between 10 and 20 to 1, but returning to 80 or 100 to 1 would require re-demonetization of silver. Given current trends, that seems unlikely. Now, I need to address the elephant in the room because I know some of you are thinking it. Yes, ratio compression this extreme has historically been followed by reversal. Yes, silver's volatility means the ratio could expand rapidly if sentiment shifts. Yes, holding silver at a 15 to 1 ratio means the easy gains have been captured. These are fair observations. Let me address them directly. Previous ratio compressions reversed because they were driven by speculation rather than structural change. This compression is different because industrial demand is structural. Solar installations are not being removed. Electric vehicles are not being abandoned. 5G networks are not being dismantled. The industrial demand that helped compress the ratio will persist regardless of investment sentiment. This creates a floor under silver prices that previous cycles lacked. Even if investment demand retreats, industrial demand continues. The ratio may expand somewhat, but cannot return to 100 to 1 while industrial consumption continues growing. Regarding volatility, yes, silver will experience corrections. 30 to 40% drawdowns are normal in precious metals bull markets. But corrections within bull markets are different from trend reversals. The structural forces favoring silver remain intact through corrections. Regarding easy gains, the move from 80 to 1 down to 15 to 1 was indeed spectacular. But a ratio of 15 to 1 at current gold prices implies silver around $200. If gold rises to $5,000, a 15 to 1 ratio implies silver around $330. If gold rises to $10,000, which many analysts project, a 15 to 1 ratio implies silver around $660. The ratio has compressed. That doesn't mean silver's rise is complete. It means silver's rise relative to gold is maturing. Absolute price gains can continue even as ratio compression slows. Let me give you a framework for thinking about what comes next, because frameworks are more useful than predictions. First, recognize that ratio compression to 15 to 1 signals cycle maturity, not cycle completion. Mature bull markets can extend for years after reaching valuation milestones. The ratio tells you relative value. Absolute prices depend on monetary conditions that remain supportive. Second, understand that the ratio is a tool for allocation, not timing. At 15 to 1, adding gold and rebalancing makes more sense than at 80 to 1. At 80 to 1, silver was obviously undervalued. At 15 to 1, both metals offer value. Rebalancing reduces concentration risk. Third, monitor the ratio for reversal signals. Sustained expansion above 20 to 1 might indicate silver exhaustion. Compression below 12 to 1 might indicate speculative excess. The ratio provides ongoing information about relative momentum. Fourth, differentiate between ratio and price. The ratio can stay at 15 to 1 while both metals rise. The ratio can stay at 15 to 1 while both metals fall. Ratio stability indicates balanced performance. Don't confuse ratio behavior with absolute price direction. Fifth, consider that 15 to 1 may become the new normal rather than extreme. If structural forces favor silver permanently, the ratio may oscillate around 15 rather than revert to 80. Historical norms spanning centuries support 15 to 1. The 60-year anomaly of high ratios may be ending. Here's what I believe is actually happening beneath the surface of this ratio collapse. We are witnessing silver's restoration as a monetary metal after decades of deliberate demonetization. The forces that suppressed silver, that pushed the ratio to 100 to 1, that convinced investors that silver was just an industrial commodity, those forces are exhausted. Industrial demand has made silver essential. Supply constraints have made silver scarce. Investment recognition has made silver desired. Monetary stress has made silver strategic. The ratio of 15 to 1 reflects this convergence. It reflects silver being valued for all its characteristics rather than discounted for its volatility. It reflects a market finally pricing silver correctly after decades of mispricing. Here's my question for you, and I want to see this discussion in the comments. Do you believe the gold-silver ratio will sustain near 15 to 1? Or do you expect expansion back toward historical averages of 60 to 80 to 1? Your answer reveals how you interpret the structural changes in precious metals markets. Drop your thoughts below. And if you've been trading the ratio or rebalancing between gold and silver, share your strategy. This community benefits from diverse approaches to precious metals allocation. Let me leave you with one final thought that captures where we are. The gold-silver ratio at 15 to 1 tells you something the market rarely states clearly. Silver has been dramatically undervalued for decades. That undervaluation is correcting. And the correction has reached a level that suggests silver's true worth is finally being recognized. 15 to 1 is not a number to fear. It's a number to understand. It reflects centuries of monetary tradition. It reflects the physical scarcity of silver relative to gold. It reflects a market finally waking up to silver's strategic importance. The ratio may fluctuate from here. It may touch 12 to 1 or expand to 20 to 1, but the era of 80 and 100 to 1 ratios appears to be ending. Silver has asserted its value. The market has listened. This is Finance Reborn. It's today's date, and the gold-silver ratio just confirmed what we've been tracking. 15 to 1, historic compression. Silver's revaluation recognized. If this breakdown helped you see through the noise and understand what's actually happening, hit that like button, subscribe to the channel, and share this with someone who needs to understand why the gold-silver ratio matters more than any other metric in precious metals. Stay sharp, transform your financial future, and I'll see you in the next one.